Okay, so what's going on? This is David W. Williams, also known as Diamond Dave, and I see now I messed up my scheduling because I had this at a 9 p.m. broadcast. Okay, and I was really supposed to do this. Let me cut this off real quick. Had it at a 9 p.m. broadcast, and I really my schedule should have been doing this at um 9 a.m. right? And so even though then I was a little late, so what we wanted to do was do like a live doing this a live Q&A and to kind of really show you what I do when I wake up in the morning to actually start trying to figure out how I'm a trader. The market is already open, but that's not going to be relevant because I normally don't place a trade within the first hour. So I will get out of a trade within the first hour, but I normally do not place a trade within the first hour. Okay. So that's the first thing. So place a trade. I'm not always trying to run into a trade as soon as the market opens. So what I normally do when the market opens, right? And this is why I got a lot of respect for another YouTuber out of the West Coast named Ask Kevin. He's up like at 4 o'clock in the morning. And that's why I don't begrudge the amount of money that guy makes off YouTube because he works very hard because I'm not a morning person. I can get up, but to get up and broadcast this early is a strain. You know, I used to do broadcast in Orlando as production and to be at a studio at 5 o'clock in the morning and got to go into a show for 7 o'clock. It's not easy because you're not really awake yet. So it's a lot to get up and then have to broadcast. But what I'm gonna kind of do is show you some of what I look at in the morning when I wake up. You got any questions, let me know. And also I'm gonna put a full like how I break down macroeconomic indicators into the VIP course. That's going to be my conversation with traders. That's going to be my contribution. And I'll probably be doing that either this month or early in the top of the year. There's more than enough content in there to accompany you, but I'll put that in there. But I'm going to show you some of that, what I will be putting in the course on this particular broadcast. So like I said before, is that it's 9:33. I'm not really tripping on the fact that I haven't even looked at. I looked at some stuff when I woke up this morning, but I had to get ready for the broadcast. So what I show you is that when you wake up in the morning, here are some of the things that you need to look at. And normally I don't even enter into a trade until after the first hour. I will exit a trade, but I don't normally enter into a trade into the first hour. And also don't be scared to paper trade. So what I may do today is just place a paper trade, right? I don't really think I'm gonna log into my account live for y'all. I don't think I'm gonna do that. But what I can do is maybe consider a paper trade. And also it may not be a trade to take at all. So just because you get up and you go through your process, you may realize, you know what? There's not a trade I want to take now. I may want to look at taking this trade right before the close, right? Because what you do in the market is you get the majority of your volume is in the first hour. Then once that first hour is over, we start getting close to what we call the second session. And once we get past the second session, we go into the third session. And sometimes you may see the volume or the volatility that you're looking for is going to be in the third session as opposed to the first session. So normally between like 11 o'clock and maybe like 1:30, 2 o'clock is where things start to slow down. And so you got to understand is that a lot of times options contracts become cheaper then, but it doesn't mean you need to take the trade just because the contract is cheaper. So what you want to do is figure out, you know, normally I don't look to take trades until after 10:30, but I will exit trades sometimes within the first 5 minutes of the open because I don't want the situation to rebound on me. So if I'm in profit and I'll hit my profit, I may get out. And normally options contracts don't reset until after the first 15 minutes. So normally when you wake up in the morning, the contracts are still a lot of times have not reset yet on your brokerage account. And if you normally wait the first 15 minutes, they'll reset. And also, if you're dealing with a lot of high volatility, that normally can level out after the first hour. So you can get into that contract and still ride that momentum, but not play that same IV spike because like we talked about before, the majority of the volatility in the market is going to be within the first hour. So if you got any questions, hit me up. But here's normally what I do when I wake up in the morning, right? So the first thing I do normally, and let me see, can I pull it up on this particular, it's going to be so I usually go to pre-market futures. And I can just go to like CNN Business. And so let me go ahead and share this out. So go here. Yeah, Miss Phineas, it's not your fault. It's my fault. First, I had it at a 9 p.m. broadcast. So that was my fault. I had my broadcast time wrong. So I should have had it at a 9 a.m. And I still would have been late though, because I'm not a morning person. So normally I just go to CNN Business and I look at the futures. That's the first thing I do when I wake up in the morning. I go to CNN Business. So we see the Dow futures is down, the S&P futures was down, the NASDAQ futures was down. Get this, well, I can get this ad out of here. Some of the pre-market movers, right? And then we see world markets are not as important because the U.S. drives the rest of the world markets, especially the Asian markets. You can go look at commodities, right? And you can also click on this and get a deeper look at commodities. Okay, so here's the oil market, gold, silver. Gold is up, silver's up, corn and wheat are all down. We know that oil is down. Okay, so we get that out of the way. This is something, heating oil, crude oil, all of that. Gas is down. Gas is down big for a lot of different reasons. These are downs. We're looking at the metals. And so let me give an example. And I'm going to kind of, like I said, I talk about this in my VIP course. If I'm looking at maybe making a play on copper, right? I wake up in the morning, the futures market is red. Then I go to the commodities, I go to the metals. Copper's down. Then I look for put plays on copper companies, copper mines, or any company that does copper mining. That may be a large part of how they drive their revenue. Why? Because the macroeconomic situation is down, right? That particular sector or industry is down. Then I go to that specific company. And that's really all I'm looking for in pre-market. And I'm looking in pre-market, I'm trying to figure out, what maybe is the cause that the overall futures market is down. Do I think that's going to transfer into the overall market? Do I see that these particular industries or sectors are also down? And then also, how is that going to transfer into an individual company? Also, the 10-year can play into it if you're looking at tech-based companies. We know a lot of times as the 10-year starts to go down, people start looking to put more money in tech because it's more speculative, right? Also, if the 10-year is down, but the market can get a better return, the S&P can get a better return than the 10-year, we're going to still see people putting money into the market, even if the overall market is down, because it's better to try to get your money out of the market than to try to get your money out of a bond. So even though the market can be down, as long as that 10-year keeps going down, people still going to keep putting their money into the market. Why? Because you'll get a better return out of the market than you'll get out of a bond. You feel me? People are just looking to try to figure out how way of getting a return. But that's normally what I do. So let me see, can I find this particular company and show you what I'm talking about? That might be it right there. Okay, so this is what I would look at. So Freeport, this is a miner, right? Let me see, this is a one miner. So let me give an example. Now Freeport is up 0.45. So this is why like I say, you got to kind of maybe wait. So let's say that, let me show you what I mean. Let's say that we said the pre-markets was red. Let me share this screen real quick. We said the pre-market was red. We saw that the actual miners was red. Then I go look for Freeport. So we showed that pre-market was red. We showed that metals was red. Then I want to say, well, maybe does that correlate to Freeport? Now, Freeport today is up at the open at 940 by 0.51%. Okay? So what we're not seeing is a transition into Freeport, but it doesn't mean it may not still trade red later on today. So what I'm doing in the morning is I'm waking up trying to figure out what is going on in the macroeconomic situation that maybe can transfer into a particular industry, that then maybe can transfer into a particular company. And that's all I'm looking for. And just because the futures are red when you wake up in the morning, don't mean the futures are going to be red when the market opens. It also don't mean the futures are going to be red over the course of the day. It's kind of just like a litmus test at that particular time. But it doesn't mean that's going to carry on, because I've seen the market open green and turn red. I've seen the market turn, open red and turn green. You never know how it's going to go. So you got to have a really good understanding of what you're trading to understand, because when we're looking at a lot of times the overall indexes, that got nothing to do with the futures. So we're looking at the S&P, the Dow, the 30, and the NASDAQ. because of how they're weighted as indexes, they can be red because of certain companies. So if Amazon and Apple are down, they can pull down the S&P and pull down the NASDAQ. But you may be trading an individual company that can be up. And you'll see that if you watch the market long enough, where the major companies in these particular, what I call indexes that are weighted, they could be individually red, but you could be trading a company that is green because they're being pulled down by what companies that have the most amount of weight in them. So these are also things that you got to look for. So just because you see the macroeconomic situation being red, you see that this particular industry or sector is also being sold off, it doesn't mean that, you may also see an ETF that represents that. So you may have an ETF that represents all the mining companies. That may also be red because it could be of a weight. But you could have an individual company in that particular sector that could be green. So don't ever assume it's going to all correlate. It may not. That's what you got to just continue to look and observe and to try to figure out, well, what could be going on in this particular company to make it trade a certain way based on my understanding of that particular company or what may be going on in the world. So that's the first thing I do. Second thing I do is I just look for any news. So when we woke up this morning, we found out that I think the CEO from Moderna stated that they could have some issues solving this issue with this new variant. Okay, he's really saying that because they're trying to push Moderna's stock price up. I don't think the market is red behind that, even though that's what the narrative that they're trying to give. I think the market is red because Powell's going to speak later on today. I think he speaks at I don't know what time, sometime this morning or maybe this afternoon. I think the market has anxiety around that. And really the algorithms have been designed to trade off when they think there's uncertainty in the market. But the CEO from Moderna, he's just trying to get the stock price to come up because Moderna is a pandemic company. They need the pandemic to keep going for them to make more money. They never put out a successful drug in the history of their company until now with these vaccines. So they were trading for well under $50 before the pandemic. Now they're trading, well over, $200 since the pandemic. So they need this thing to keep going. So that's what people got to understand. We got a lot of corporations where they need the pandemic to be a reality and to be a live situation for them to stay relevant and for them to continue to get the share price to go up. So that's just what I think that conversation is about. I can't really wait that. I think we got to try to figure out how people are going to deal with that. Is this even going to be a big deal? Because virus mutations are not abnormal. They are normal. That's really how viruses conduct themselves. So I don't think it's something that people should really be worried about. So another place I would go in the morning, the first thing is this website called Briefing. See, can I get it together? Okay, so I got that. Let me pull that up real quick. I go to briefing.com. And the reason why I go to briefing.com is because they usually give me a pretty good kind of breakdown of what's going on in the market from a pre-market standpoint. They also got some really good information there also. So briefing.com, let me try to zoom this in a little bit more. So we get an overnight summary. World markets right about Moderna CEO warning of efficiency against Omicron variant. Like I said before, is I think that's kind of overstated. And normally what they do, and they're now updating their information at 9/22, but they really give you a concise understanding of what's going on in the market a lot of times before the market opens. So, he talked about that the current vaccines will offer a material drop in effectiveness. He's saying that because what does that mean? We got to make another vaccine. So that's good for their business. If the current vaccines don't work, then we got to make another one. Right? So I don't think it has anything to do with the overall world. I just think that it's good for their business to have to make another vaccine because right now they're in the vaccine business. They're essentially a pure play company. They just make pandemic vaccines. They don't really have any other solutions medically for anything else, right? So I wouldn't really look into what that guy's saying, and I don't think the sell-off is based on that. I think the sell-off is based on the fact that I think the Fed is supposed to speak this morning. We have this particular company is going to report this afternoon. Square caught an upgrade to neutral at Bank of America. And then he potentially, the guy that writes this thing, is Marquetta. So here's 820. And then we have the same thing. So you got to get a kind of like a briefing of everything that's going on in the market. Futures market turns negative. Material drops. So Powell's going to speak at Senate Banking Committee at 10 a.m. Regeneron COVID antibody drug cartel thought to be less effective against Omicron variant. UNH dips on guidance. Travel stocks get hit down again. Rating actions for these particular companies. Crude futures down based on slowdown. Treasury yield 1.44. We talked about that earlier. The Eurozone inflation at an all-time high. Then we got to 6 o'clock, right? And so we get to Asian markets. We also get that 6 o'clock update. 10-year at 1.4. So what I normally do when I first wake up in the morning is I go to briefing. And what I like about briefing is they take a lot of information and they just essentially aggregate it and make it really, really concise for me to read it, for me now to kind of understand, okay, where do I need to go? And they also, when you wake up in the morning, they give you which companies are really selling off or really pushing up really hard in the pre-market, which can be important kind of based on whether or not you got trades on those specific companies. So that's normally the first thing I do. Then I normally will a lot of times go to the overall pre-market. Okay. Not always concerned about the Asian markets because I don't really trade the Asian markets. I don't trade Forex. So I don't really care how the Asian markets are really doing unless it's something really big like the whole Chinese real estate markets getting ready to sell off. Because normally the US market drives the rest of the world markets. Then from there, I will start looking at, if I'm in individual trades, I will want to see how are they trading from a pre-market standpoint. Now, there's two ways you can do that. You can go to yahoo.com, and we'll go back to Yahoo real quick, and you can look at those individual companies and just see where they're trading at pre-market. So let me go back to Yahoo. Go here. And so let's go to car, right? Because I looked at that pre-market. So car's at 293 trading currently. Now the market's open. So what we see is they sold off on the open. I think they also gapped down. Now what you got to understand is that when you're looking at pre-market, right, you don't get to see the volume is going to be skewed because it's pre-market. So just because you're looking at a company that may be red or green in pre-market, it doesn't mean that it's going to open that way. Why? Because the volume is skewed because it's pre-market. So you got to always take that into consideration. You normally don't in pre-market get the same amount of volume that you would get in the regular market. But also what you want to understand is that if you are getting abnormal volume in pre-market, it could mean something. So let's say a company has a really, really bad earnings. Let's say they average 3 million in volume on the daily. In pre-market, they're red 1 million. That could be an indication that they probably may keep selling off over the course of the day. But if you wake up in the morning and a company normally averages 2 or 3 million regular, during their regular trading hours, then the pre-market, they're down by $10, but they've only got maybe 50,000 to 100,000 in volume. It may not carry over. Some people just may have decided to actually exit that particular position in the pre-market just because they don't want to have to try to figure out how to do it in the early market. In the regular market. And you just got to take that into consideration. So I don't always look the pre-market to try to make a determination on whether or not to make a trade, because the trading volume is abnormally a lot of times lower than what you would get in the regular market. So there may not be a carryover. Same thing in the aftermarket. I've seen companies trade flat in the aftermarket, wake up the next morning and go really, really bullishly green in the pre-market. And then when they open, they keep going green. But for some reason, people decided to exit that particular trade in the aftermarket. So you can't really worry about that. It's just sometimes can be something that you can maybe use as maybe I would say like maybe a litmus test on where you think it's going to go, but nothing is more important than the actual market. So looking at car, right? Looking at car, we see that it's selling down, but we're still within the first hour. All right. So what we may look for is that at 10 o'clock, we still have a lot of conviction that this is going to keep selling down. Because if we look at, let's say, their 5-day, look at their 5-day on 11/26, they was at 277. And then they hit that support and they bounced back up, right? Then what did they do yesterday? They gapped up back to this 314, sold down to a 302, bounced off that, and then, pretty much came back down to that support again, and then traded sideways. What did we do this morning? They gapped down off 305. We're trading now at 295, but we're still not under this. So if you jump into this, unless you're going to scalp this, which can be difficult because it's a thinly traded options chain, you jump into this trade right now, it can do the same thing it did on 11/26. It can bounce to this 278 and then bounce off the support. Because it's a thinly traded options chain, it's going to be difficult for you to scalp it because it's not a really robust, it's not like it's Apple or it's an index. So that's one of the reasons why I tell people it can sometimes help you to get past the first hour and to really see how this is trading. Because if we see here, this did this around 12 o'clock, 11:50, right? But the issue with this scalping it is you can't get in and out of the play really fast because it's thinly traded. So you may believe, okay, this is going to keep going down, but based on the risk that you got to take to get into the contract, based on the cost of the contract, what contract would you buy? Because if you don't get this to continue to push under this 277 and it bounces back up, what's going to happen next? So this is why I tell people a lot of times it's best to just sit back and wait, right? Unless you got a lot of conviction on the play, or it's a very high volume option chain where you know if you made the wrong decision, you can get right back out. Sometimes it's best just to sit back and wait. And because this is not a really heavily traded, so we have 70,000 at almost 10 o'clock. So this doesn't trade really a lot. There's not a lot of trading activity here. So rushing into this play really fast is not going to be beneficial to you, right? Because the problem with a play like this is, and we got sent to call Avis for some reason. Rushing into a play like this, my bad. Rushing into a play like this, the issue is that small trades can turn it around because of low volume. You feel me? So you don't want to do that. So let me look at another company. Let's look at, the market is overall red today. So let's look at Apple. See, so Apple's green. So even though the S&P is red, the NASDAQ is red, Apple's green on the day. In fact, Apple's driving up. See, so this is why, so you can't just assume that just because these are red, that every company in that particular index of that ETF is also going to be red. You know, you can't assume that. And so Apple's driving up, but I would do the same thing. Before I jumped into this, just on the information that I have, I would try to see, can I wait to the first hour, right? And so let me look at the 5-day, and we're seeing the same thing. So when we get here to this 162, this is where Apple, it got here, it closed here, and then it sold off the next day. So are we going to push way past this 162 and get some continuation? Or are we going to do the same thing? We're going to hit this as a resistance point and then sell off. And then we got another one here at 165. Now, with Apple being a really robust options chain, it's going to be a lot easier to scalp it. So if you want to potentially play this 162 with the hope that we can hit the 165 and then I can scalp it, it'll be easier to do that with Apple. Why? Because it's such a liquid options chain and it trades on a much higher volume. So let's go to the summary. It's already at 12 million and we're not even at 10 o'clock yet. And it normally averages 78 million per day. That's its average trading volume. So it's going to be a lot easier to get in and out of the trade. So if you wanted to potentially scalp this, it's a lot easier to scalp it. Why? Because there's a lot more liquidity here as opposed to car. And like we talked about before, we can't assume just because these are red, these individual companies are going to be red. And so these are the things that we're going to look at. So we see that Facebook is red on the day. So one day come out. So what we see is a gap down, and then Facebook comes out and trades sideways, right? Let's get rid of the, I don't know why we keep getting all this constantly loading up. Let me get rid of the 1 minute candles. By now, I should be able to go to 5 minutes. And that's what we're seeing. So we're seeing the gap down, and then it's starting now to just recover. It looks like it may trade sideways. So this is why you don't want to run into trades, because you can run into this trade on the first bar as on a put contract, and then now it recovers. So then the question is, what is your expiration date? And where did you think it was going to fall to based on what news? So just because, oh, the market is red, we got news about COVID, even though to me, COVID is good for social media, and we're seeing the NASDAQ getting ready to turn around. It's already getting ready to turn green, right? So we may see, even though this started red, within the first 30 minutes, this is already trying to turn around. We may see this turn around. And these are the kind of things, that's why I say the first hour is normally where you just observing, unless you're exiting a play. But others outside of that, normally I'm just trying to observe to where I think the market is going. So normally, even if I don't have a trade that I'm getting ready to run, I would normally catch the first hour open of the market, unless I got an appointment or I got something I got to do. Because I just want to see how the market opens up and what direction it goes into. Then I'll go normally start taking care of other things that I have going on that day. But I've been catching the open every morning for probably about 3 years. Now, some days I can't because I got an appointment real early. I can't. But normally, even if I got trades and I don't have to worry about exiting because they could be longer term plays, things of that nature, I normally always try to catch the open. And you just want to start seeing a lot of opens. And how does the market open? How do people respond? Start seeing how you get the majority of the volume of the day, the first hour of the day. How the market can be red, but individual companies inside that particular composite, I would call it, can be green. How the composite can be red, and the top companies that are indexed in that particular composite can also be red, but you could be trading an individual company that could also be green. And that's some of the funny things that you're going to see in the market. So you just can't like template it, well, if it's this, it got to be this. It's all a case-by-case scenario. What you're just looking for is indicators that can make you do a lot more in-depth research. But there is no paint by the numbers in the market, right? That's what a lot of people are looking for, but it doesn't work that way. A lot of trading is discretionary. How are you discerning what it means by this information that's being presented in front of you? And you just got to, find out whether or not you're right or wrong. But it's not play everything by the numbers. The only thing I say with play by the numbers is always take profit and manage your risk. But as far as what the market is telling you, it can change day to day, and it's discretionary. So how you discern it, or your discretionary ability to, if I'm saying this properly, to evaluate the information that's being presented in front of you can change from person to person. Two people can look at the market and have two totally different interpretations of it. So that's pretty much what I do in the morning. So let me go back to StreamYard. We got any questions about anything? Because we got 35 people on the chat, which is decent. So we got any questions about anything? Because what you don't, I'm not going to place a trade just because I'm up or just because I'm live streaming. Like, people got to get out of that. You don't have to make any trade at any given time. You should make a trade when it's the best scenario to make a trade. You shouldn't just make a trade just because I woke up. Or this is part of the internal work that you got to do as a trader. Or just because the market is running, I got to make a trade. Because this right here, like, I've been watching this company, right? I've been watching this company for a long time. Okay, so now we at 291. So we're selling off. We're at 87,000 though on volume. So on 5-minute bars, right? We're on 5-minute bars, but we're still selling down. Now, I've been watching this company for a long time. Now on 289. Okay. But what did we talk about before? Until we get under here, I'm really not convinced it's a sell-off. That's 277. Right? Because really what we're doing is we're just filling this gap. Right? We're just really filling this gap right here. See what I'm saying? See all this gap? We're just really filling this gap. Until we get under here, I'm not convinced that it's a sell-off. But you can be so enthusiastic to get in on the trade to where you rush into this, and like I said, it hits this 277 and bounces back up. Now, because it's thinly traded, it's thin options chain, it's going to be hard to turn around and get back out of this trade without taking a big loss. So that's why you can't be pressed to make a trade, right? And what you'll find is that sometimes trading less is better than trading a lot more, but you got to kind of get through that process. So just because you up in the morning and you see something, it don't mean to take a trade. But let's say hypothetically we was going to paper trade this, right? So let's go to the options chain. I would look for, with this company, I would only look for leaps. I wouldn't look for anything short term. So I look for like a May 2022. And I look for, and let's see how thin this options chain is, right? So there's really nothing in May that I would even want to trade. Let's go to maybe February, which is after their earnings. Okay, so I see something decent. Okay, so this haven't really updated yet, but I would maybe look at the 270, maybe the 270, and really bunch it because I know it's not going to hit 140. I would maybe look at the 270, right, at the 43, and then try to see can I get in there. But like I said, where did it hit? It hit that support around that 270 something mark before. So this is why this is such a dangerous play, because it's thinly traded. The options chain is also thinly traded. Where's most of the volume at? So a lot of the volume is on the earliest strikes, and they put those in there recently. This right here only used to trade monthlies. There were no weekly contracts for this. So we see people going into the weeklies, but these are the most dangerous trades. So they ended December 3rd, which I believe expires this week. So we got 552. We got this 155. We also got this 550. I don't think this hits 270 by December 3rd, but I could be 100% incorrect. And look at how wide these particular spreads are. So this is why, like I say, these are dangerous trades if you just want to try to jump into something. Maybe the Royal Caribbean, because the travel stocks are being beat down because of the uncertainty around this particular variant. So let's look at the chart real quick. So we at the 10 o'clock hour. Let me look at their yearly. Okay, so they gap down pretty hard. And I wish we would stop getting the updates, but I don't know what's going on with that. Let's go to the 1 year. So most of the supporters around the 65, we're at 68. So what I would want to do is see if we bounce back up off this 65 mark around here. If we bounce off of this, or if we push under it, then I would maybe look at put contracts, right? Because it's very likely we fill this gap up. This gap between 78 and whatever this opening bar was here, it's very likely we fill this gap. But we do have support around this 65, 67 mark. We're trading right now at 68. So I will look to see, do we bounce off of this or do we keep going back up? That's what I will look on World Caribbean. So once again, we're really not in a position to make a trade right now. Let me go to the 1 week. We're really not in a position to make a trade because I want to see, do we bounce back up off of this and go back up, or do we fall back under? And we got to have a justification for that. So just because the market is kind of skittish around this particular scenario, it doesn't really justify. This is the pandemic. We made a lot of money on this trade because of this. I mean, this is just crazy. But we got to figure this out. So that's why I tell people, don't rush to jump into no trade because your support and resistance are still there. So just because you see some early movement on the first 30 minutes, it doesn't mean it's going to continue because your historical support and resistance areas are still there. And they're there for a reason for you to use as a guide. So with this, I will look to see what direction do I think is going to keep going? Am I going to get continuation? And what do I think is going to allow that continuation to increase? And let's also look at the summary. So we're at 900,000, almost 1 million in the first hour. So that's really, really good volume in the first hour. But again, try to figure out, is there going to be any indication? Now, some people, we're at 10:05 now. Some people may want to wait the first 30 minutes and it's okay, now I got enough conviction to place my trade. But I may say, you know what? I want to see, is it going to go up under that support line? And then if it goes under that support line and I think that I still got some continuation, then I will maybe try to trade it, right? But if I, whether I'm going to scalp it or do like a longer term trade, but that's what you really got to look out for. But don't rush into anything. Just because you're up, just because you see movement in the market doesn't mean that you got to make a trade. You make the trade when you think it's the best time for you, not because everybody else is doing something that don't have nothing to do with you, right? And that's one of the things a lot of people struggle with is the anxiety or the need to always be in something without realizing that there's so much money in this market. Sometimes if you just sit back and wait, the situation will present itself as opposed to you thinking you got to go in. Okay. All right. So Brando Barney, I'll give you some information at the end of the class of where you could go. So Gregory says that you only watch the market for the first hour. When does it come information overload? Yeah, usually the first hour, Gregory, what I'm watching, and I can't show you this because I can't show you my phone on the live stream, but in the course, I teach you how to use WhatsApp. I teach you how to use, what's the name of that program that I use? Let me see, can I get Webull? I teach you how to use Webull in class 2, the applications class. So Webull is free. I don't use their brokerage or their trading platform. I just use them for information. A lot of times will look at level 2 data on Webull. What I'm looking for is I'm looking at level 2 data. I'm looking at what is the bid and the ask. I'm looking at what are people asking for, what are people bidding. Also with Webull, I'm looking at volume. Also with Webull, I'm looking at orders. Are they putting a lot of big orders in, or there's a lot of small orders, right? And you can also look at Webull. I did a video on this on your laptop or desktop. It'll show you inflow and outflow based on the date. Is it, historically over the past 3 to 4 days, has it been a lot of outflows or has it been a lot of inflows? So normally the first hour, I'm looking at the display on my laptop or my desktop, and I'm also looking at my phone. I'm looking at level 2 data. It's not information overload because I'm only looking at certain things and I'm not looking at other things. So, and I know when I wake up in the morning, what I want to look at, right? I know waking up in the morning, but because I wake up before the market, I know what I'm looking at. I know what I want to look at. And all I'm trying to do is just observe, because I do a lot of paper trading. So I may have paper trades that got nothing to do with the trades I'm actually trading with money, right? The problem with car is I wouldn't even paper trade it because the option chain is so thin. I need a better chain right now. But no, I don't get information overload because I know right what I'm looking at. So you took a good trade on Apple. So was it a call or a put? PhD program 2012. So one thing I look at particular companies. Right. So I have in a program we talk about, I call it a Power 5, but you can just have one company that I look at on a consistent basis. So I've been looking at I've been looking at Avis for over 6 months. So that's why when somebody tells me, well, they're trading with low volume, no, they're not. That's normally their trading volume was around 300,000 on a day. And we see that by their options chain. So I look at certain companies all the time. And then I have other companies that I call maybe casino plays. But I normally have a list of companies that I literally look at them every day. Like I said, whether or not I may look at them in the first hour, but never take the trade. I just want to observe and maybe look at how are they trading the first hour this day. I may go back again and look at them again later that afternoon. And I may look at them again on the close. And then I may look at it in the aftermarket. And then I may look at it again on Sunday when I look at them like on the weekly. But the difference between me and a lot of people is I'm not a day trader, right? So I don't have to wake up every day and find a trade off technicals. I have specific companies or specific scenarios that I'm looking at, and I just keep focusing on those. And I don't necessarily care about what's going on around me, because what I've done and I found is that I've lost a lot of money chasing stuff that everybody else is doing. Have some of those people made a lot of money off of it? Yeah, but it doesn't mean that's what I need to do. So if I don't know if you look at my community page, I was in Peloton in July because I literally have been looking at for Peloton for a year. I should have took a larger position. That could have been easily a $15,000, $20,000 play off 3 or 4 grand. But I wanted to manage the risk because just as much as it went the way I wanted it to go, it could have went against me. So that's the thing, is that I had been looking at Zoom since the top of the year. I told everybody that Zoom's going to keep selling off. So I got into that put contract because they were a growth company that is losing growth every 90 days. So they're still driving good revenue, but they're no longer a growth company. They're starting to plateau, which means that they can't support that share price anymore. So companies earn my attention because I locate specific companies based on what direction I think they're going to go in. Because what I look for with companies is I look for companies to where their value is disconnected from their price. That's what I look for. Most people can't see the difference between the two. I can. So I look for companies to where their value is disconnected from their price. And I wait for the market to actually start to see that. Right? With an average person, they can't see the difference between value and price. And that makes sense because we got people that are paying, you know, $150,000 for an automobile. Right? No car is worth that money. But they can't separate value from price because they're not buying a car, they're buying status. And for them, the status is worth the 150. Same thing with a college education, right? And no disrespect to you having a PhD. So because I understand that most people can't really discern that, that's an opportunity for me to make money because I have the ability to discern the difference between value and price. They're not the same, right, in the market. That's a good question, though. So with leaps, I don't always look for, so I'm looking for volume and options chain so I can get out of the play. It don't have anything to do with leaps. So if on car, if I can find leap contracts that had a good options chain, it would be attractive to me. You know, leap puts. The problem is that their options chain is very thin because they're a very thinly traded company. So even though they got a lot of attention on their run up, nobody trades that company like that, right? They probably right now at 1013, they're probably not even at 100,000 in volume. Apple probably did 100,000 in volume within the first 5 minutes. So the dangers of that play is that if it doesn't go the way you want it to go, you're going to have to take a big hit to get out of the deal because it's so thinly traded. And that's what I talked about people before is, you know, you got to watch out for these particular companies that are thinly traded. When I'm looking for leaps, I'm looking, as a rule, I'm looking for tight spreads. So I know I can get in and out of the play the way I want to, right? That is separate from leaps. As a rule, when I'm looking at options contracts, I'm looking for a tighter spread. Now, is it always something that I have the ability to get into? Sometimes I don't. But I teach everybody that's a novice to put yourself in the best scenario to be successful. You don't, as a novice trader, I'm not talking about you specifically, but I'm just talking about in general, don't want to get in bad situations because you don't have enough experience to know how to get out of it. So that's why I tell novice traders, try to find the tightest spread that you can find. Try to find the most amount of open interest that you can find. Why? Because it's going to make it easier for you to get in and out of the play. As you get more experience, then you can start getting into more difficult scenarios. But, you know, everybody should, in my opinion, should start off with the basics, which is the highest amount of open interest that you can find, which you see on companies like Apple and Ford. They got ridiculous, you know, Apple will have literally 70,000 open interest on a chain. The spread will be 1 cent or $1 in between the ask and the bid, which means that it's really easy to get in and out of the plays. Same thing with the SPY. These are easy plays to get in and out. Same thing with a lot of the bank stocks. They're high volume tickers. So they put you in the best situation to be successful. Then once you start getting more experience and seasoned as a trader, you can trade companies that are a lot thinly traded because you understand the scenario that you're getting into that's separate than the case study of the particular company. But as a novice trader, you don't want to go into where you don't really know what's going on with the company like that. And then as a result, you don't really understand the options chain. Then if it goes wrong, you got to take a 60% haircut just to get out of the play. And you also trading with too much money. No, it's situational. So it's all situational. So this is what drop 16. I want you to understand something. I got very few uniform rules as a trader. Biggest uniform rule is that every time you go into a trade, know your exits. What are you willing to take profit at? Where are you willing to exit at if you take a loss? That's what I teach in the course, right? And stick to that. Now, you can let your winners run, but most people don't lose as traders because they let their winners run. Most people lose as traders because they don't exit when they take a loss. Other rule, buy as deep in the money as possible and buy as most expiration date as possible. And if you can't do that, then consider not taking the trade. Don't buy out of the money just to be in the trade, right? Because if you notice, if you do that over a long period of time, you'll notice you lose more than you win. A lot of this other stuff is case by case. Why? Because it's based on the situation. So like I said, this is a discretionary skill. It's based on your discretion. So we got to get away from, there's a template and there's a way to template this every time. Doesn't work that way. Traders are utilizing a discretionary skill. So what you got to work on as an individual is your ability to discern what's going on. And that's where the self-work comes in. And that's one of the reasons why we in the VIP got the mindset council, because most people, they're bringing their issues into the market. So the one person that talked to me about the fact that they have issues with decisiveness, that got nothing to do with the market. But if they come into the market with those issues, that will impact the way they trade, right? Because they're not decisive, right? So that's the thing, is that there is no certain percentage. I would look at the situation and how does I think that institutional holding percentage is going to affect the way this trades. Because it doesn't matter if it's 100%. So let me give you a scenario. Let's say we got a company that got 100% institutional ownership, right? And it comes out that there's been accounting fraud. And the accountant of that, the CFO of that company gets arrested by the FBI. We see it on TV. They walking the guy out of the office, right? Do you think the fact that they have 100% institutional ownership mean that that company does not sell off? So I'm going to rephrase the question because I know it was really, really long. So I'm asking you, and I'm asking the audience, this is a question. We got company XYZ. They have 100% institutional ownership. News comes out that there's been accounting fraud with this company, and the CFO of the company is arrested by the FBI because they're a suspect of being involved in this accounting fraud. We see it on TV, the guy being walked out of the offices, right? That company opens up the next day. The stock market opens up. Do we think that company will not sell off even though they have 100% institutional ownership? That's a question I'm asking the audience. So we got 35 people. I don't understand this question. If institutional owns 100%, who are they selling to if retail buyers can see the same? I don't understand the question. So based on the question I'm asking, I don't understand this question, right? I would consider thinly traded anything under $1 million a day. Me personally, right? That's just me. Anything under $1 million a day to me is thinly traded. And you'll see it in the options chain. Anything under $1 million a day, $1 million, $1.5 million is thinly traded to me. That's a good question, though. I think you should keep a journal. So in the VIP, we have a trading plan, but we also got like a spreadsheet. But you can build one out yourself. I'm fairly confident that you have the ability to utilize Excel. And you should record all your trades. Because if you was working for somebody, they would be recording all your trades. And if you went on a bad run of trades, they'd probably fire you. So you should do it the same way. You should have that level of seriousness. Record your trades, record your the company, the strike price, the entry, the exit, just record it. And over time, you can, figure out what particular metrics work best for you, what KPIs work best for you. But I would record it. I would record your paper trades also. And then look at it quarterly, yearly, whatever, and determine whether or not what you're doing is working, whether you need to, reposition some things, yada, yada, yada. But I would record your trade. It don't take anything special. Just bring out like a basic Excel sheet or do it on hand. Quad is kept. All this trading that we see now done with computers, they used to do with pen and paper back in the day. And they did it for a very long time. Yeah, I know we're on a delay, but I don't know what the delay is. Because when I watch YouTube, I don't see a delay. But I noticed that I'm on a delay. I don't know what's going on. When I watch YouTube, it don't seem like it's a delay. But, everybody internet work different. So that's the thing. So what you got to understand is that it's a scenario about institutional ownership. Now, you get scenarios where institutional ownership can protect the company. So let me change this. What's the name of that company? I can't even remember it. Oh, okay. I now know what it is. Okay, so we got DoorDash, right? So let's go to their chart. Let's go to their 1 year. Okay, they've sold down a lot over the past few days. So on day candles, so we see they hit that 250, got around 250. They sold down really hard, right? So essentially the market rejected that 250. Now we're around the 175 to 200. They might trade into this range. Now here is based on Yahoo. We have the institutional ownership at 90.85, if you can see that. So 90.85. I think that's what's protecting them from selling off. I think institutions have not made the money that they want to make on this ticker yet. I have no idea why this thing keeps reloading all the time. So I don't think institutions have made the money that they want to make off this company yet, right? Once they make the money they want to make off this company, I think they're going to start dumping this company. Because if we look at profit margin, negative, operating margin is negative, return on assets is negative. So if I'm in this company, my return on assets is negative, return on equity is negative. If I'm in this deal, I'm not getting an equity return. Got decent cash in the company, don't have a lot of debt. Cash flow and levered cash flow are positive, right? But what they really probably should do is buy shares back, but they probably won't do that. But we got a lot of institutional ownership. So I think maybe, and they're red on the day, maybe, right, they get maybe one more earnings. Let me see when their next earnings is. February, they get maybe one more earnings before they start to sell off. Or they may sell off before earnings. But if we look at their chart, this company has been protected through institutions. Institutions that protect this company, but they're doing the same thing to Uber also. So we're seeing this big run up. Got all the way up to 250 before it started to sell off, right? Now, with institutions being in this deal, they'll probably protect the share price by buying up any loose shares. And that's one thing that you see with institutional ownership. It's hard to get a total collapse until the institutions decide to get out of the deal, right? So that's normally what you see, but it's all situational. And so, like I said, there's not these universal rules in the market, right? The way if this happens, then just do this. It's not like that. It's not paint by the numbers. It's a discretion. Trading is a discretionary skill. So is investing too. Everybody think they got this investing template. It's discretionary. You know, while one person may value a company a certain way based on their formula, another person may value a company differently based on their formula. Just because Warren Buffett does it doesn't mean that's what you need to do, right? But that's what people believe because they don't want to do the work. So they figure I'll let Warren Buffett do the work and just piggyback off his trades. You got to understand something. Warren Buffett could have a terrible year. He's still going to be a billionaire. If you go behind what Warren Buffett does and you have a bad year, you could lose 60% of your net worth. That's the difference between the two. And people don't understand that because they don't want to do the work. They want Warren Buffett to do the work without paying Warren Buffett. So drop 16 says, if institutions own 1%, who would the institution sell to? I see the info board, nobody's buying the CFO. So what you got to understand something, drop 16, the market maker is the buyer or seller of last resort. And they could find somebody to sell to. Why? Because you'll have somebody that'll say, well, you know what? I may not like it at this price, but I'll buy it at this price. Right? So I may not like it at 100, but I'm willing to take the risk to buy it at 45. So let me give an example of what I'm talking about. That was a good question, though. But understand the market maker is the buyer or seller of last resort in the market. So let's look at Peloton, right? Let's go to the chart. Let's go to the weeklies. Go to the weekly. So Peloton at one time traded at 164. It's trading at 43.97, right? So we do know that somebody was willing to buy it at this price. Now somebody's willing to buy it at this price. Right? I wouldn't buy it at either price. Somebody's willing to buy it at this price. Somebody was willing to buy it and open at 91 and close at 55. Somebody's willing to buy it at that price. Here's a price that opened at 137, closed at 120. Somebody was willing to buy it at that price. So just because you bought it at this price, don't mean you're going to be able to find somebody. If you bought it at 164, closed at 151, don't mean you're going to be able to find somebody to buy it at that price, but you will be able to find somebody to buy it at a price. So let me get you what I understand. If I bought in here at 32 and I sold here, great. If I bought in here at 130 and I sold here at 55, it's still great. I don't know why you want to buy this at 44, because now you got to believe it's going to go back up to 50 or 100. So what you got to understand is that if I'm an institution, I could have bought in Peloton at $35 and then sold here when it was coming down off that 150. Because if you look at that chart, and this is one of the reasons why I knew this company was over, the chart starting to fall apart here. The chart's falling apart, right? It tried to recover back up here, and it started to fall apart again. So one, the market makers, the buyer, seller, or last resort. But if you're an institution and you've already made 300% off your money, you're willing to sell and take profit. Because most institutions are not in deals for 25, 30 years. That's how retail thinks. Institutions, especially hedge funds, which drive the majority of the trading behavior, they try to make their money and get out, right? So I'm in Apple forever. Most institutions are not in Apple forever. And this is why, so let me give you another example. This is why you saw this during the pandemic. This is what people got to separate retail and the stuff they tell retail people from how institutions trade, because everybody is taught to think like a retail person. Okay, so let's go to the weekly. Okay, so this is 2020. This is the pandemic. See that selling? Somebody's taking those trades though. And you got these idiots on the internet when this was going on saying, well, the RSI is saying it's oversold. This is what I told people before. There are no uniform rules in the market. They think because the RSI is giving them a number, it means this just has to go back up. It's not like you're flying a plane and the plane says that you was at 10,000 altitude and now you're at 5,000 feet altitude. So that means you got to pull the nose up because you're getting ready to crash into the ground. That's not how this works. So the whole time this was selling off and me and Mecca was having $1,000 days, people is on message boards saying that these are weekly candles. These are weekly candles. So this is a red week. This is a red week. This is a red week. The RSI is saying it's oversold. Doesn't matter. What? Because the scenario is institutions is pulling out of this deal. So it just keeps selling and it keeps selling and keeps selling. And the institutions are able to find buyers, right? Because they believe, well, you know what? This is the bottom. It's getting ready to bounce back. The RSI is saying it's oversold. Well, this is the bottom. It's getting ready to bounce back. The RSI is telling me it's oversold, as if the RSI is a uniform indicator. Just because the RSI says it, that means it's going to happen. The RSI is telling you what's on the chart. I keep telling people, all an indicator can do is give you information off the chart. The question is, what is the market telling you about this company? Because this is a representation of supply and demand. So that's why I tell people, you got to learn markets before you try to step into the market. But I just want to look at the RSI indicator. I got a guy on YouTube tell me he's going to give me the secret RSI number. He got the secret because I believe in secrets. See, so this is why I try to get people to understand is that there is no uniform rule of trading. It's a discretionary skill. My discretion told me the fact that you had a boat off the coast of California and you had a bunch of people on that boat that had been tested for the pandemic virus, and they was not giving us information on whether or not those people was positive and negative, meant they was positive. And as a result, because I come out of the healthcare industry and I understand communicable diseases at a very deep level, bloodborne pathogens, the whole 9 yards, because I used to have direct patient contact, I knew that this was going to impact this particular industry really, really hard, because their whole business is based on people being in tight spaces really, really close to each other. So I knew they was going to sell off. And the institutions knew it too. And the institutions started pulling out while people, retail was complaining that it's oversold and it's at the bottom and it's getting ready to bounce. And it just never bounced. And this thing sold off. It got down to what? I want to say $12, $10 before it bounced back up and it sold back down again to $12. And then it's been in this trading range literally for the past year, year and a half, right? But if you bought into Carnival at $15, $20, you was able to exit out at 42, or maybe even exit it out here. You saw the same thing with the airlines. So you got to kind of separate your understanding of the market as a retailer from institutions. Institutions are here to make profit. An institution makes 10% profit, they'll exit. They make 50% profit, they'll exit. It's us at retail trying to get 100% or 130%, 100. They're dealing with such large amounts of money, they don't have to play that game because they're playing the game of volume. They drop the price to, it doesn't matter. They just trying to get out of the deal. And like I said, the market maker is the buyer or seller of last resort. So if nobody else buys it, the market maker will buy it. The question is, what price are you willing to sell at? That's why I tell you, always go into a deal, know where you're willing to take your loss at. Don't never go into a deal not knowing you're going to take your loss at, right? And separate how you, separate your idea of what money is. Understanding that big firms are operating on volume. So 10% on 100 million is different than me trading with $5,000 and trying to get 100% return. And they playing a different game. So they can go into a deal and over 90 days, get a 5 or 10% return and exit and put their money somewhere else, right? They don't have to be in this stuff long-term like we do and try to get long-term appreciation. They'll deal with the tax implication later. They're just there to make money. Do I think about TTCF as a growth stock? I don't. So BB, do this. Tell me your thoughts about TTCF as a growth stock, and let's have a conversation about it. So tell me your thoughts, and you can even come on the stream. I can send you the link, and you can come on. You ain't got to put your face; just give me your voice. But tell me your thoughts on TTCF as a growth stock. What's your narrative on the company? Yeah, but drop 16. Most people, like I said before, they don't understand markets. That's the problem we have in America. Is we don't teach people markets. You know, we have a school system where you get one semester of economics in 12 years of school. So we produce people that, like we talked about before, they're very educated, but they don't understand markets. But you live in a market-based economy because you get one semester of economics in 12 years of school. So that's the issue. So then they go into the market, and like I said, they take all their belief systems that they have going into the market, which is there's a secret. I don't want to work. I don't want to do the work it's going to take to be successful. I'm not good at making decisions. I don't want to admit that I'm wrong. All these issues. That's what impacts their ability to trade. Got nothing to do with whether or not they know how to push a button on a mouse or anything of that nature. So they believe this stuff. It got to be a RSI number that makes me successful. I'm one of the few people that actually know how to trade, that actually tells you what the real secret is. It's you. It's not that I have a secret RSI number, or I have a secret way of looking at support and resistance, or I have a secret way of reading the MACD. Because all of those, and I talk about this in the course, all of those are indicators off the chart. So if you don't understand supply and demand, then you won't understand anything about the market because you don't understand the fundamentals of a market, which is supply and demand. Or you know, you can read option scanners and become successful. Well, the scanners are indicators. So you're not successful in the market because you know how to read scanners. But what did we talk about before? People are looking for the secret. I talked about this in fitness. I know a young girl, she's blowing up in fitness. She don't want to teach people that there's a secret. I said, well, you ain't gonna make no money in fitness because people in fitness is trying to buy the secret. If you read the crowd will tell you that if people believe in something and you try to give them the truth, they'll destroy you. That's why I tell people to read the crowd and to keep reading and reading and reading. So what I'm doing is really dangerous to me because I'm telling people there ain't no secret to trading except you. Most people think there's a secret. The only secret is that you got to kind of figure out how your own brain works. And PhD program 2012, I appreciate the cash, the super chat. Ontario Geddes L, I appreciate the super chat. Let me see something real quick. So we got Okay, so we good with likes. So hey Bibby, like I said before, give me your interpretation of TTCF so we can have a conversation about it. Because I'm not an oracle by any stretch of the imagination. You know, I pray, and I'm not a prophet by any stretch of the imagination. If I did, I would be playing like lotto and stuff like that. I wouldn't be trading. I play lotto and just sit back and kick it. So I don't know like this future by like, trust me, I don't. Yeah, if I did, I wouldn't, you know, I would not have made the mistakes I made because I knew what was going to happen. So you knew to invest and you bought the food, vegan options, and I was curious about investing, decent marketing and placing Costo, Marco, TTCF. Okay, so if you're new to investing, my question is, why not just buy into an index fund and stay away from individual companies? So I'm gonna ask you that question. If you're new to investing, why not the index instead of that's the drop 16, that's the cash app. So that AB, but I'll answer the question. And I don't want to answer your question with a question. But my thing is, if you're new to investing, why not just buy you an index instead of individual companies? And the reason why I'm asking you that is that, are you willing to do the research it will take to learn about a company? That's what I'm asking that. Because you can avoid all of that by just buying an index. Just buy Vanguard and kick back. And then you ain't got to worry about this stuff because they'll do it for you. And you just pay them a little bit of money to manage it. And you just keep putting your money into an index. You know, that's, you know, one of the things about this market is that if you want to get money out of this market, you got to be very serious about sacrificing a lot of your time to do it. If you don't have the time and you can't do it just because of the way your life is set up, or you're not interested in doing that, to me, the best use of I'm not an investment advisor, I'm not a fiduciary, but to me, the best use of your capital would be just buy index and let them do it. And you essentially can, you know, you don't even have to do that. You can go buy SPY. And that's the overall S&P 500 and just invest in the U.S. economy and keep it moving. Because investing in individual companies is difficult if you're not willing to put the time into it, right? I had a guy tell me you should not buy into any company until you've done at least 100 hours of research. I wake up every Sunday and I do 4 hours of research on plays I may be looking at the next week. I may not even play them, but I do 4 hours of research on Sunday. Do that every Sunday. That's where I do the majority of my research at. So if you're new to investing and you don't know anything about that company, I would just consider just an index. And Michelle Green, you're right, but you can go get you like a Vanguard that does the whole overall market, not nothing specific like airlines. Go get you a Vanguard that does the whole U.S. economy and kick back. and just keep stacking your money over there. You know what I'm saying? Because the U.S. economy, unless the whole United States falls, it should be higher in 20 years than it is today. And then if you want to get all amount of, like I said, the only safe investment, the only non-speculative investment or trade is the treasuries, right? Because the U.S. government will be here in 20 years or 10 years or whenever you get ready to exit. But the returns are not going to be that great, but it's pretty much a guarantee. So you got to just weigh it out. So the only non-speculative investment is treasuries. Everything else is speculation. But if you don't really want to just sit down and really study and look at discounted cash flows and all that and figure out a model that works based on whether or not you think this particular company is worth your investment, I would just tell you to invest in an index. But asking somebody on YouTube what they think about a company, to me, is not a good way to go about it, because I can have a personal bias against vegan companies, and I can let my personal bias influence my my view, and I could be 100% incorrect because of my personal bias about vegan options, right? Or I could be bullish on something because of what, a lot of people on the internet are fans of CEOs. So they are bullish on a company because they like the CEO. Got nothing to do with the company. So that's why I tell you is that if you're not willing to do that research, just buy into an index. Look at the SPY, look at a Vanguard. They're really good at what they do, because looking at individual companies, the investor, I've done a lot of research on Apple, done a lot of research on XOM. These are companies that I invest in individually. I research them on a regular basis all the time, right? I know what's going on with those companies. I know what's going on in the energy markets. I understand OPEC. I could turn Venezuela around if they let me get down there. They'll probably kill me, but I could do it. Why? Because there's too much money down there. How they got a country that broke with all that money in the ground? It don't even make no sense. But I know this because I studied the energy market for so long. And I'm not one of those people that think because of EV cars, oil's dead. I don't believe that, because I've studied the market. And that's my interpretation. Other people got a different interpretation. I can respect that. So I would tell you, if you're not really willing to do a lot of individualized long-term research on an individual company, I would stay away from it regardless of its price point. I know TTCF is not trading at a really high share price. That could be attractive to people, but there's a reason for that, because they're very speculative right now. They're very uncertain. They're very growth oriented. And also, if it's a growth company, where are you looking to exit at? Because we're seeing that with a lot of the growth companies, especially the pandemic companies this year. A lot of people are realizing that, I might have bought in at the top. And a lot of retail, what they do is they buy in at the top and they end up selling at the bottom, right? They buy in at the top, they end up selling at the bottom. That's what happens to a lot of retail. To make money in this market, the way that the American stock market is set up, you don't have to be a great stock picker. You just got to be consistent, right? You just got to be consistent, and you can take advantage of diversification through indexes, and you can just index. You can invest in the overall American stock market, which, based on how our economy is set up, will go up over time. You don't have to be anybody special, and you just consistent in investing in the overall American stock market or the overall American economy. Unless this whole thing implodes, you good. And if you're worried about imploding, just buy U.S. Treasuries. You're going to get a terrible return, in my opinion, but that's the safest place you can be, because you're investing now in the United States government. There's a reason why the Japanese owe $1 trillion U.S. Treasuries, because they've invested in the U.S. government, right? Even though you let the internet people tell us that, they are enemies, but they've invested in, they've got more. The Chinese government, the Chinese Communist Party has more investment in the U.S. government than the average American does, right? So they have more confidence in the United States than the average American. Average American don't own any U.S. Treasuries. So we got any questions before we pretty much get out of here? Because we at like the, my bad. We at like the 1 hour mark. But that's pretty much all I do every morning. And like I said, it's no guarantee I'm going to make a trade. I may not make a trade. But I pretty much watch the open every morning, right? And I just go through that process and I just sit back and see what happens. But I'm not pressed to make any trade. Sheree, it's all cool. I had the wrong time anyway, so it's not your fault. I put 9 p.m. I don't know how I got that. right? And I was late anyway, even if I did 9 a.m. I'm not a morning person. So, you know, it's a lot to broadcast early in the morning. Well, Greg is going to be on the YouTube. It's live streaming the YouTube at the same time. So you just watch it on YouTube. So we got any questions before we get out of here? And I appreciate everybody coming through. We got 43 on the live stream. And I appreciate the cash apps. I'm sorry, the super chats. Definitely. Not having a position is a position, right? Being cash is a position, right? So you don't have to take a trade. You don't have to. Sometimes taking less trades is better than taking a trade. A lot of times we're chasing a dollar amount monthly, and we take trades chasing that dollar amount, but the money's going to come, right? The money's going to come. You ain't got to force it. It's out there. Just, be patient. It's out. The money's out there. You're talking about a New York Stock Exchange got a market cap of like $80 trillion, $70 trillion. The few thousands we trying to hit, that's nothing. That's an accounting error, less than 1%. So that's the thing. Okay, so I'm not asking his opinion versus on things I'm researching. Yeah, so I'm jumping in based on, okay. Yeah, so that's the thing. So, but Miss BB, my opinion of the company, of an individual company, I get it, but it can be skewed based on my bias. And so I would encourage you to do your own research. And like I said, it's like, let's have a conversation about it as opposed to like, what do I think about it? Because, I don't know the future. If I did, I would just play lotto. I just play Powerball all day and just be caked up on Powerball, be in Vegas, just chilling. You know what I'm saying? Because I wouldn't care how much I lost because I just go back and play me another Powerball ticket. So but I appreciate your question. But I'm not a fan of this YouTube thing to where people kind of give this analysis of companies and I listen to them give the company and I know they don't know what they're talking about. So I got a YouTube video in which I broke down my short analysis of Avis. That was hours of research. Like that was hours of research for me to do that in like an hour. That was hours of research. Because what I'm trying to get us to understand is if you become an expert on a company and you learn how to trade it successfully, it's what I teach inside my course, and you can show a track record of that, people will pay you money to teach them that. This is what I don't think we're seeing. Is there's people, especially older people, and I've seen this because I've counseled with people and I've seen people show me their, I had one lady I was teaching options to. She had probably $500,000 inside her account. And she was trying to figure out a way how to get a return on it because the banks don't give you nothing. The money market accounts don't give you nothing. The CDs don't give you nothing. But she had built all this money up. And so what I'm trying to get people to understand is that if you become an expert on a company and you can trade it successfully, or you understand how to do a long-term investment play in it based on your analysis, people will pay you money to come in to talk about that particular scenario. The people that have money, right? It's people in this, they got a lot of money just sitting up, getting no return. So that's what I want people to understand. So, with CAR, if you were a short seller, not necessarily an options guy, but if you were a short seller, that CAR report can be very valuable to you because I broke that whole thing down and it took me hours to break that down. I sat up and did a lot of study and I had been looking at that company for 6 months. So if you're a short seller, not necessarily an options trader, that can be a very valuable report to you. You just got to figure out, is it worth the risk to pay the brokerage fee to sit in that position short? And how long do you think you're going to sit in there? But like I said before, I think that loses between 70 and 90% by this time next year. Right? It's impossible. I think they're going to have really good earnings for this next one because of holiday travel. And then from there, it's going to start. And once they solve this shortage of chips, it's over for them. Because there's no way in the world that company's worth $300. I don't know what it's trading at now. Let's look at it real quick because we passed the first hour. Let's look at CAR real quick. See? So it's at 2. 287. So what we see is that now it's continuing to move down, right? It's continuing to move down, still not under that weekly support that I saw. And we still at 200,000 volume going into 11 o'clock. So very thinly traded, but it's down 5% on the day. So it may continue to, we may end this day at 10%. So it may be starting its sell-off. So now this is the deal. So looking at the 1 day, so let's go back to this real quick before we get up on out of here. Okay, so let me get rid of BB. So we're talking about the first hour. So now we at the 11 o'clock hour. We got continuation on this sell-off. So we just use this as an example. Let me get rid of this 1 minute. Let me go to the 15-minute bars because these bars are so thin. It looks terrible. So we have 15-minute bars. So what are we seeing? We just seeing this continuing to sell down. Okay. Now we talked about before on the 5-day that we had like a weekly support of around 277. We're still nowhere even close to that. Right. And we're not getting a lot of volume. So this thing is moving very, very slow, which is what I don't like about this ticker. But let's say hypothetically, I want to take a shot at it. I wouldn't go December 3rd. I'll maybe go December 10th. And nothing on the options chain. But let's just say hypothetically, I will look at the 290. Now that 290, they want $1,800 for that. It's a lot of money for essentially a 2-week contract, right? But that's what they're charging. One of the reasons why they're charging this money is because they know it's going to fall. So they're trying to scare people out of options contracts. So I would maybe look at the 287. Yes, December 10th, maybe the 287. Let's look at the December 3rd. Maybe the 290. So 12, 20, 930. You may be able to bid 1,100 to get in on this deal. But that's the contract that expires this Friday, which means you don't even have a lot of time, right? And it got a 74% IV. So this thing has to keep falling down. So 287, 990, the 290, 1220, right? The 552. I probably definitely wouldn't look at this 280. So that's what you got to understand is that this to me would be better as of right now from a short position. You maybe would look at, let's just say you had the bread. Look at the January 2023. So I was looking at the other day. Where is it at? The 100, right? But you're essentially parking that money, right? You're parking it, and you got to ask yourself: is it a good use of capital to park this money here, right? To park it here, because I like this contract, and you probably could get it for 13, maybe 14. 665, that's not bad. Open interest of 96% IV. I definitely think by this time next year, it's under $100. This is not great. Look at that big great, but you may have to try to finagle that. And I don't see anything else. So you got to ask yourself with this deal, do you park your money here, which means you may have to pay $1,500. Do you park your money here at this $100 strike? And just watch it continue to fall and move towards your $100. The threat of this play is that it's at 100 and it's currently trading now at 286. So you're $186 off the strike price. So the question we want to ask is that based on the return that you think you can get off this play, is it worth taking the risk of parking your money here? Because it's not like you're buying in the money. You're buying $186 out of the money. This is why I was telling people the other day, don't think you got to take the hard play. Because in between now and let's say this thing goes the way you want it to go. Let's say you get 100% return. Let's say you get a 200% return. But in between now and when you get that return, unless this collapses really, really hard within like the next 2 weeks, 2 months, could you have made that money somewhere else instead of parking your money here? This is why I say it's a discretionary skill set. Now, if you just got the extra bread, you can just park it here and don't worry about it. But you're $186 out of the money. So maybe there's an easier play that you can make to get your money, even though I have a lot of conviction that this thing is going to collapse. right? But I may look to trade it as we get closer to its next earnings, because even if it's trading at $200 or 180, it's still way well above its actual value, because we talked about before, just in October, November, September, that it started moving north of 100, where now it's trading at 287, right? So that's what I'll be looking at. So now we passed the first hour based on this particular options chain. It still doesn't mean I should make a play, but we're seeing everything else is turned red, even the Russell 2000, even crude oil. So today just may be a red day. Now, what a lot of people do is they say, you know what? It's a red day. That means buy calls, because calls are going to be discounted. Doesn't mean buy calls. It means that you may see a good scenario to buy calls, but it don't mean buy calls. There is no uniform stuff in this market except for just the basic rules that I believe in. But I don't believe in, well, because it's red and calls are going to be discounted, it means buy calls. Because if you look at this, they're right. Because it's a red day, a lot of the calls, let's go back to December 3rd. A lot of the calls are losing volume, losing value. I'm sorry. It doesn't mean buy calls, though. It don't mean buy calls just because the day is red and calls are cheaper now because the day is red. Right? So this is the kind of stuff people, they try to template this game. It's not like that. This is a discretionary skill. Cherie, I do. You can reach out to me about the one-on-one consulting. Hit me up on Instagram. I don't know if you have my I don't know if you bought the course. When you have the actual, if you bought the course, you get 1 hour consulting with the core course. You get like 4 hours with the VIP. If not, just hit me up on Instagram and I can just give you the price point for the 1 hour. Yeah, definitely. These is facts, Chastity. Yeah, but see, drop 16, the majority of options trading is done through institutions. So if you get a chance, Google the CBOE in Chicago, which is like the options market. And those trades are not being done by retail. They don't have the money to play in that field. All right. Retail activity on trades is very small. The market is driven around by institutions because they got the capital to push the market. So if you look at the Apple, you got to realize that the media outlets, they market to retail, because people that run institutions don't care about what these media outlets have to say. They know what's going on because they're driving the market anyway. So the media outlets have to sell to retail because that's who consumes their information, right? So they got to include retail in what's going on in the market. But you know, this stuff, I think retail buying into AMC, they're going to find out what happens when institutions don't hold up companies. I think they're going to find out the hard way. Now, it could blow up and go to the moon. It could. But I think when this AMC play is over, a lot of people are going to find out what happens when institutions don't hold up companies, right? But it's institutions can't, I mean, retail can't support options. You look at the SPY options chain, that's institutions. That's not retail. It's too much money on the chain. It depends on the situation. So, Nurse Nails, what was your goal when you bought the contract? Before you bought the contract, what were you trying to do? Yeah, Cherie, if you bought the course, especially if you got moved over to the Teachable site, there's a contact information in there as far as just emailing me, and the admin will set you up with a consult through like a calendar link that sets you up with a consult. So that's part of you buying the core course. Like I said, you get an hour with the VIP, you get 4 hours. Yeah, so Nurse Nails, when you bought the contract, what was your goal before you bought the contract? No, but they're selling their information to retail. So they got to figure out a way to include retail. Right? Yeah, good for them, man. I mean, I don't think they got anything to do with the share price, but you know, they could give out candy bars next week. I don't think they got anything to do with the share price. You know, the week after that, they could give out you know, gold statues of, I don't know what the AMC mascot is. I think is it a box of popcorn? They can give out gold popcorn boxes. Got nothing to do with the share price. Got nothing to do with the actual market that they exist in. Got nothing to do with the fact that they got a lot of debt that they got to figure out how to pay back. And they're going to be driving less revenue next year than they're driving this year. Right? But they can give out those NFTs. I mean, I'm a fan of marketing. But at the end of the day, the business is still the business. And unless you're in a marketing business, the business is still the business. Right? You know, Peloton can do an NFT. It don't change that business at the end. It's not going to change that. That's why I tell you, you know, you come to me for an analysis on the company. I might not tell you what you want to hear. You know what I'm saying? That's why I'm not always enthusiastic about doing that. Because if you ask me about it, I might not tell you what I look at markets. I don't, all that other stuff ain't got nothing to do. At the end of the day, you got to make money. So if you wanted to was to acquire capital. So why didn't you sell the contract then? Irregardless of the lockdown, drip coatings, they weren't driving the revenue. So, you know, what was their revenue before the pandemic? I mean, people act like AMC started running their business like 3 years ago. They was around when I was a kid. I used to go to their movies when I was like a teenager. So then what is the overall market for movie watching? We going into the metaverse and people talking about going to the movies, four wall in the movie. We talking about the metaverse. Like, I don't get it, but you know, it is what it is. Everybody see the world different. We talking about the metaverse and then we having a conversation about a company that four walls movies. That's how they make their money. Okay. Keep buying it. That's all I got to tell you. If you believe in it, keep buying it. So then why didn't you sell it if you was trying to acquire capital? As opposed to exercising it, which you would do if you wanted to try to control the shares. So I would encourage you to get a solid options training. So we offer that at www.thehightestpaid.online. 15% off is Black Friday. We're still running that particular sale. We're going to keep running that sale. But the price of the course will go up. And I would tell you to get into that because I'm thinking about the questions you're asking. You kind of don't understand the fundamentals of the options market. All right, Greg, peace out. So we don't have any questions, man. I'm gonna get up on out of here because it's 11 o'clock. So good for me. I did my Tuesday video, so I ain't got to do it this evening. But this is what I'm trying to get people to understand. That's why I say people got to really research companies. Look at their revenue over the past 5 years, irregardless of the pandemic. Right? This is why people got to really research companies. Look at the movie theater industry. Was it contracting or expanding before the pandemic? So was movie theater revenue contracting? So look at, you got AMC. Who are the comparables in that particular space? You got Cinemax. You got other things. Was their revenues contracting or expanding before the pandemic? This is why I tell people, y'all don't want to ask me about companies because I don't put on pom-poms and mini skirts. I don't choose up under CEOs. We don't do that. So, you know, I'm not a tech dude. To me, you know, y'all don't really like technology anyway because y'all don't like guns. You know, so y'all ain't into technology. So that's the thing is that we don't ask certain questions around companies. We go with real surface level stuff, and that's cool, but that ain't always what's going on. You know, when you're looking at the movie theater industry, my question is, were they a contracting or an expanding market before the pandemic? Because we can take 2020 and throw that out of the window, right? That's a lost year. That's a sunk year. So let's look at 2019, 2018, 2017, 2016. Was revenue contracting or expanding during those years? Was revenue contracting or expanding those years? So from 2016 to 2019, was revenue expanding? Were we driving more revenues? Were we having more guests or attendees or whatever you call it? Do we believe that the market was expanding for four-walling movies? Based on that, that tells you where the market is going. Because the actual consumer behavior of consuming content is changing. Now we're going into the metaverse. We're going to have virtual real estate. And I just had a consultation with Chastity. You should hit her up. She does consults on NFT and things of that nature. We're going to have virtual environments where people are going to go and watch virtual movies. And we're talking about a company that four walls movies. Now they're probably going to move into an event-based company, but four walling movies is just going to be very movie specific. It's not going to be how I was when a teenager, where everything went to the movie theater. Right? It's just not going to work that way. If I was AMC, I would be sinking all my money into virtual movies. I get out of the four wall game because it's going to be it's a contracting market. Would there be money in it? Yeah, but not enough to justify their share price. Right? Got nothing to do with it. So like I said, they can issue out an NFT. They can issue out a gold ball of popcorn. They can issue out another marketing tactic. Got nothing to do with the fact that consumer behavior is changing around how people consume movies. I watched the whole NFL draft on my phone last draft. Watched the whole draft on my phone. I don't even understand people with big screen TVs anymore. I don't get it. I'm watching everything on my phone now. I watch most movies off my computer. I watch most TV shows off my computer. Watch the NFL draft on my phone. The way people consume media now is changing. And what's a trip is I'm older than a lot of people, and they consume media like old people. Right? And I'm older than a lot of people, but they consume media like old people. The younger people still consuming media like old people. And maybe it's just because I'm tapped into, digital technology a lot more because I come out of that space. But it's amazing to me how many people that's 25 years old is consuming media like 50-year-olds. You know what I'm saying? It don't even nobody's going to be consuming media like this in the future. It doesn't work that way. But we, as independent filmmakers, was talking about watching everything off the phone and off apps. We was talking about this in the early 2000s, right? Because we knew this is where everything was going. But because we had got into non-linear editing early, right? Where they were still in Hollywood cutting tape. Well, we as independent filmmakers was doing non-linear editing with programs like Final Cut and things of that nature. So it may be because I was so tapped into digital technology that I'm ahead of a lot of stuff. But it's interesting to me when I know somebody that's 25 years old and they got this big screen TV in their house. And I'm like, you really sitting here and watch this big old TV every day? And you got all these mobile applications to where you can watch content that way, and you sitting in this house and you sitting still and watching this big old TV like it's 1987. But that's just me. So we don't have any questions. I'm going to get up on out of here. I appreciate everybody coming through. So like I said before, is that reach out to the course. And yeah, I don't know why. I don't know why they up, because I wouldn't buy a TV. I don't own a TV and have no desire to own one. I don't get it. I don't see the appeal of it. It's big, it's clanky, I don't get it. But let me say, that's me. Everybody's different. But it's always interesting. I know young people, and they got these big old TVs, and I'm like, what year is this? Is this 1993? Like everybody's sitting around watching TV? I don't get it, but that's me. I'm trying to figure out when they're going to start beaming the TV show. Like I want to see the hologram TV shows. I don't even want to look at a TV screen anymore. I'm trying to get to that level. But everybody different. And I come out of like the movie space, but people like what they like. But I think four-walling movies is a dying industry. Will it be around? Yes. And I think it also will be around for independent films. But when I was a kid, when every movie got four-walled and that's how you made your money, I don't get it. Yeah, I mean, I remember when Apple was trying to launch the Apple TV, and Roku kind of took off what they was trying to do. And I get that, but Go to, like, if you get a chance, I'm a big fan of like what I call trend spotting. A lot of times what's happening in technology is what's going to be happening in American technology, especially digital technology, is what I should say. What's going to be happening in American digital technology is what's taking place in Asia right now. And one of the reasons why I knew that the phones was going to be really, really big is because I knew somebody that had went to Asia. This was like in the early 2000s. And they were talking about how all the young people over there was walking around with their phone in their face. You right? And everybody had their phone. They was walking around, had their phone up in their face like that. We see this now all the time. So one of the things that I would do is look at what are the media consumption trends in like Japan, places like that, because they're really cutting edge with digital technology. And to me, that's where we're going. Because a lot of things that we're seeing that we're calling the metaverse have already existed in places like Japan. And we're now just in America kind of getting hip to it because they're always pushing the boundaries in those particular areas, even though nobody really talks about it. But I just think the way we consume media is going to be totally different. And so investing in these old school media consumption models, to me, don't make a lot of sense. Right? And like I said before, is that we can throw the pandemic out of the equation and look at their revenues over the past 4 or 5 years leading up to 2021. Right? It is a reason why they was in so much debt. It was because they needed to take on debt to run the business because they weren't driving the same type of revenue. If you look at Cinemark, their share price has, I think, moved down because the market just isn't there anymore. Right? Yeah, I watch YouTube on my phone. I don't own a TV. I haven't owned a TV in years. I watch sports on my laptop. So, you know, chick come over my house. You know, we ain't finna be watching a whole lot of TV because I don't own a TV. Right? So we either got to leave, do an activity, do something, but I'm not a fan of just sitting down watching a whole bunch of TV. I'll watch a movie every now and then. I'll watch a TV show, but I can't sit in the house and just watch TV. I used to be like the person that watched the sports all Saturday, all Monday, and I wasn't making a lot of money when I was doing that either. You know what I'm saying? That's the issue. We live in a society to where entertainment is really, really big, but I can't get caught up in that. Definitely, they lead. You know, they're so. That's why I tell people, you want to know where we're going in digital technology and media consumption digitally, just look at Japan, and they'll tell you where we're going. You know, they really will, because what they're doing right now is what we're gonna be doing in like 5 to 10 years. You know, but in America, we don't talk about what they're doing over there because we want to make it seem like we invented it. But what they're doing right now is what we're gonna be doing in 5 to 10 years in America, right? And the model that Facebook has for social media, they got that model from China. It's a Chinese company that does what Facebook is getting ready to do. They got that particular model from China. So Asia is really leading the way with a lot of these digital technology and media platforms. But we don't really talk about them because we in America want to make it seem like we came up with it. So that's going to be it, man. We've been on here an hour 43. I appreciate everybody coming through. If you could go ahead and like the particular video, share it out. This is David W. Williams, also known as Diamond Dave, and I will talk to you later.